Today we're covering what might be the most important precious metals discussion you'll hear all year. We're talking about silver's absolutely explosive move, where it's headed next, and why some of the top market analysts in the world are calling for price targets that most people think are completely impossible. Right now, as I'm recording this, silver is trading around $34 per ounce. Gold is marching toward $5,000. And the question everyone's asking is this sustainable? Is this a bubble? Or are we actually witnessing the beginning of something that's going to completely reshape the precious metals markets for decades to come? I recently came across an analysis from a market technician with over 4 decades of experience, someone who actually called the 1987 crash, and what he's saying about silver is absolutely mind-blowing. We're not talking about silver going to $100, we're talking about potential moves to $300, even $500 per ounce, and much of it happening within the next 6 months. Now, I know what you're thinking. That sounds absolutely insane. That sounds like hopium. That sounds like the kind of thing people say to get clicks and views. But when you look at the technical analysis, when you understand what's happening in bond markets right now, when you see the structural breakouts that are occurring, this isn't just wild speculation. There's actual methodology and reasoning behind these projections. If you want to understand what's really happening in the silver market right now, smash that like button, drop a comment with your thoughts, and make sure you're subscribed because we're going to break down exactly what's driving this historic move. Let me start by explaining what makes this precious metals bull market different from previous ones. According to this analyst's momentum-based structural analysis, this isn't behaving like a normal bull market. For well over a year now, both gold and silver have been moving in what he describes as an arm wrestling manner. What does that mean? It means you see these metals shoot up. Maybe gold goes up a couple $100 or silver jumps $10, and then they go sideways for 5 months. They bore everyone to death. People start thinking the rally's over. Analysts start calling tops. Then suddenly it breaks out again and you get another congestion zone. It's been laborious. It's been frustrating for people trying to trade it. But here's what's changing right now. It's no longer laborious. According to the technical work from multiple angles, not just looking at price and momentum, but examining the spread relationship between silver and gold, we're entering what's called a move to new reality. This is a specific technical phenomenon that's been observed in other commodity markets. It happened in copper back in 2005. Copper, in a matter of just a couple of quarters, quadrupled in price on its own without help from any other market. It went from an old multi-decade horizontal trading range and just exploded, boom, out of here, and quadrupled into a completely new price reality. Lead did something similar in 2007. These weren't gradual moves. These were vertical explosions that caught most people completely off guard, and the technical patterns that preceded those moves are showing up in silver right now. Now, here's the critical question. Why has silver been stuck in this $50 to $40 range for so long? Why has it taken this long to finally break out? That's been the frustrating part for silver investors for years. You hit $50 in 1980, you hit 50 again in 2011, and then you collapse back down. It seems like there's some kind of ceiling that silver just can't break through. But according to this analysis, that's exactly what's changing right now. The measurements based on a variety of factors, not just looking at silver itself, but examining its relationship to gold, looking at structural momentum, analyzing historical patterns in Moss. The movie is going to take silver to a completely new reality, and much of it is going to occur in just a few quarters. The clock on this move started in November. That's the critical inflection point. In November, when you look at the relationship of silver price to gold and plot it as a spread, essentially what percentage of gold's price is silver trading at. At silver there was a ceiling that went back years. Silver would rise and bump against a certain level relative to gold's value, and it just couldn't get above that percentage. It kept hitting resistance at that level. Make sure to hit that like button if this analysis is opening your eyes to what's really happening. Comment below with your price predictions and subscribe for daily precious metals coverage. That ceiling broke in November. Silver finally broke through that relative valuation level compared to gold. And historically, when you go back and find other instances of this type of behavior where silver breaks free from its suppressed valuation relative to gold, it's interesting and see recency de dova mai doten trade tenchi eden pain. It then tends to go vertical for a couple of quarters afterward. But this time there are additional factors in play, fundamental factors, macro factors, technical factors. All of them are aligning simultaneously. That's why the projection isn't just for silver to go to $100, which would already be historic. The technical work suggests a vertical move that could take silver to a couple $100, possibly $300 to $500 per ounce. Now, I know that sounds absolutely crazy. Let me give you some context for why these numbers aren't as insane as they sound. Various angles of analysis all point towards similar conclusions, and the analyst believes a lot of this move is going to occur by the second quarter of this year. We're talking about the next few months potentially seeing the most explosive move in silver that any of us have witnessed in our lifetimes. Obviously, this wouldn't occur in isolation. Gold is also moving higher. Gold is headed for $5,000 right now. And according to this analysis, 5,000 is probably way too low as an ultimate target. Let me give you a historical comparison that puts this in perspective. If you go back and look at the bull market from 1976 to 1980, gold had an 8-fold gain, 8 times. From the low to the high, gold multiplied by 8. Now look at 2001 to 2011. Another 8-fold move from the prior bear market low to the bull market high. Our bear market low in this current cycle was $1,050 in December of 2015. An 8-fold move from that level, that's $8,000 and change. That's just for gold to do what it's already done twice in the last 50 years under far less dramatic fundamental conditions. Right now, we're only a little past 4-fold from that 2015 low. We're not even halfway to where gold has historically gone in major bull markets. So $5,000, while it sounds like a big number, is actually quite conservative if you're looking at historical patterns. But here's where it gets really interesting for silver. What if gold goes to $8,000 again? And what if silver breaks out versus gold, which it's already doing, and goes up to 3% or 6% of gold's price? Those are numbers silver was trading at in 2011 when gold had that bull market run. Silver's spread in 2011 was 3.1% of the price of gold. Right now, we're at just 2%. In 1980, when silver surged to $50 for the first time, it was 6.5% of the price of an ounce of gold. Consider those numbers for a moment. If gold hits $8,000 and silver returns to just its 2011 spread of 3.1%. You're looking at around $250 per ounce for silver. If it goes to the 1980 spread of 6.5%, you're looking at over $500 per ounce. These aren't pulled out of thin air. These are historical relationships that have existed before. Now, let me dig deeper into why this breakout is happening now. What's changed? Is it the China story? Is it that silver can no longer be manipulated the way some people have long suspected? What's really driving this? According to this analysis, it's all of the above, but the bigger picture that people aren't talking about enough is this. We're headed for a monetary crisis. Fiat currencies are in jeopardy. This isn't just about silver being undervalued. This is about the entire monetary system facing a crisis of confidence. Go ahead and smash that like button, leave a comment with whether you think this monetary crisis is coming, and make sure you're subscribed so you don't miss any updates. If you've been paying attention to bond markets, and you should be because this is where the real crisis is brewing, the Treasury bond market is in serious trouble right now. Not just US bonds either. Japanese bonds effectively crashed recently with yields exploding higher. UK bonds don't look good. Western world bonds across the board are showing signs of stress. We're no longer talking about a mortgage crisis like 2007 to 2008, where individual homeowners lost their homes. We're talking about government debt markets that dwarf stock markets in size. These are the foundations of the entire financial system. Look at 30-year Treasury bond futures. They crashed between 2020 and 2022 in price, which means yields exploded higher. The price low back in October of 2022 was at 117. In the subsequent 3 years, there have been rally attempt after rally attempt in bond prices. 3 major attempts to recover. 3 is usually all you get to climb out of the hole. The Federal Reserve can cut rates all they want on the short end of the curve, but it doesn't affect long end rates the way they'd like. And each rally attempt has failed. Right now, bond prices are trading in the 114s, even touching 113s. The technical analysis suggests that this 3-year process of trying to establish a base or top yields is failing. If you roll over about another 3 points or so in bond prices below recent lows, you could be headed into what would be called a bond panic. And you cannot have a US debt market panic without catastrophic consequences. That would be like a nuclear event in financial markets. The Fed knows this. They're the printers of last resort, and they'll print gold higher because they destroy their own currency in the process of printing to save the bond market. In November, the president of the New York Fed, Williams, said in a speech that the Fed was going to start buying bonds. His stated excuse was just to provide more liquidity in that market. But look at what's happened in bonds since that statement. The market went flat, dead sideways for 2 months. Daily and weekly price ranges became incredibly compressed. It didn't even look like a normal bond market anymore. What does that tell you? It suggests they were buying, trying to support the market. But the rallies couldn't get going despite their intervention. And now prices have punched through recent lows anyway. If the Fed isn't in control of that beast, and the evidence suggests they're not, GC and can cause in ripple effects in other financial markets that will force central banks everywhere to take drastic action. We're about to get a new Fed head, but here's the reality. It doesn't matter who's running the Fed at this point, because they can no longer control what's happening in bond markets. The new head will print too. The president wants him to print. So you've got both a president and a Fed that's going to engage in monetary expansion. You might think, well, that's good. They're going to put out the fire. They're going to solve the problem, but they're not. They're just going to create more money supply growth. If you go to the St. Louis Fed website and pull up M2 money supply data, you can see exactly what's been happening. The money supply has exploded. That's what gold is the other side of. Gold is real money. They can't inflate it. They can't print more of it. They can't manipulate it the way they can paper currencies. And they've tried to manipulate silver by keeping a lid on the price for years. Usually when somebody tries to manipulate a market, whether it's a big trader or a government entity, and they're fighting against the natural direction of the market, and it seems to succeed for a long time, all they're doing is creating compression. Think of it like a coiled spring. When it finally does break through their attempted barrier, it goes even more explosive on the upside than it might otherwise have because it's been held back for too long. It has what you might call a panic on the upside. That's what we're starting to see in silver right now, and especially in the gold to silver ratio dynamics. There was actually a headline recently that captures what's happening. Wait, sell America, US dollar, treasury prices tumble, and gold spikes as globe flees US assets. The sell America trade is in full effect. Now, everyone's going to want to blame various political factors, but frankly, the underlying fundamentals that are problematic have been bad for decades. It's the ongoing inflation in the money units. We're not the Weimar Republic doing hyperinflation, but in effect, we're doing the same thing in a slower, more controlled form. You print, and prices of everything go up. Bread, stocks, real estate, everything. Some things go up more than others. If you've owned gold for the last 10 years, you've beaten the stock market, but it's all false. It's all distortions created by monetary expansion. And you can't keep playing that game indefinitely, because finally you'll have what looks like an accident. Though it's not really an accident, it's a consequence. Make sure you've hit that like button, drop a comment with your thoughts on the bond market crisis, and subscribe to this channel for daily analysis. When consequences show up in government bond markets, which are huge, it causes intellectual doubt among everyone, among academics, among the voting public, among investors who thought certain things were going to improve, but instead they're getting worse. When nothing seems to work and your retirement account suddenly wipes out years of gains, people in the street start asking, what is going on? That's when you get uncertainty. And when uncertainty comes into markets in a big way, emotion takes over. And when emotion drives markets, that's when you get explosive moves. That's what drives precious metals to levels people think are impossible. Here's the thing about awareness and public perception. Most people aren't waking up to this reality yet, at least not in Western markets. Right now, if you look at internet commentary on silver, the prevailing sentiment from free analysts online is sell silver, short it. This is the top. It can't go any further. What are these people doing? They're looking at an arithmetic chart, a simple dollar price chart of silver. And admittedly, when you look at it from that perspective, silver was around $40 to $50 just a handful of months ago, and it's almost doubled. So in a normal market environment, you'd say, well, that's a pretty good gain. Time to take profits and get out. But the technical analysis suggests this has just begun. This isn't the top. This is the early stages of a much larger move. And here's what's interesting. Despite all the doubt and despite all the calls for silver to top out, somebody is buying. Not just somebody, institutional buyers, bodies with serious capital. There's been this pattern over the last several months. Every time silver has had a 10 to 15% drop and it looks terrible on a daily chart, that's actually been the buying opportunity. If you go back over the last several months and look at every time silver dropped 8, 10, 15% and you had bought instead of selling, you'd be way ahead right now. The doubters keep getting proven wrong, but they keep doubting anyway. There's this overwhelming skepticism even as silver continues to prove strength. And here's an interesting observation about how this is unfolding. Before silver hits a new high, you get these pause periods where doubters come out in force. Gold did this back in April. It went sideways for 5 months. Doubters everywhere. People saying the rally was over. Then it broke through and jolted higher. In October, there was another pause, but that pause was only a couple of months, shorter than the previous one. Then another surge higher. Same pattern in silver. You had this wide pause around $35 through late 2024 into early 2025. Basically a whole year of boring sideways action with a $35 cap. A whole wasted year from a trading perspective. People got bored, they doubted, they gave up. Then it broke through and jolted up another $10. It's been a layered process of breakouts and consolidations. But here's what's really interesting. This pattern is now showing up on intraday timeframes. You might see silver surge to $35 and then spend the whole day selling off back to 33, but instead of lasting 3 months like previous consolidations or even 2 weeks, now you can measure these pullbacks in hours. Things are speeding up dramatically. The time compression between these pauses is shortening. That's a sign of an accelerating trend. That's typical behavior when you're entering a vertical phase of a move. And what could be the catalyst that creates the headline crisis to really ignite this? The Treasury bond event we've been discussing is possibly that catalyst. In previous surging moves in silver, for example in 79 to 80, where silver went up fivefold in 5 months, or September 2010 to April 2011, when it went up 2.5 times in 7 months. In the middle of each of those explosive moves, there was what you could call a stumble or correction. For instance, in January 2011, in the $30 plus range, silver had a monthly reversal where it made a high for the month but closed down. Price chart technicians would have called that a bearish reversal signal. But the very next month, silver blew the lid off and went even higher than before. There was a midpoint stumble, but it didn't end the rally. It set up the next leg higher. If this Treasury bond event continues to deteriorate for another day or two, it could panic the Fed in a way we haven't seen before. We could be talking about an imminent event here. Days, not weeks or months. This could be the catalyst that gets us to that midpoint stumble in this 6-month explosive phase in silver. Imagine we're heading into February with major headlines about bond market stress. Here's a thought. The Supreme Court is scheduled to decide on tariff-related cases. The timing of their decision could be significant. There's speculation that they might rule against certain tariff implementations, potentially as a way to calm markets and stop the panic selling of US assets. If that were to happen, but only after a panic phase first, after Treasury bonds have clearly broken down and silver has gone vertical for several days, you might see silver not pause until it's at $120 or $130. You could have limit up days where silver moves 10% per day on futures exchanges. Traders who are short would be unable to exit their positions. There could be a point where that Supreme Court decision tries to temporarily put a dampening effect on the panic. It won't ultimately stop the larger trend because there are far bigger forces at work, but that could create one of those events where silver goes absolutely berserk beforehand. The stock market takes another major hit and Treasury bonds move into what would be called a panic sell-off. At that point, the non-owners of silver or the people who have been shorting silver suddenly think, uh-oh, I've been on the wrong side. I should have been long. And the shorts who are trapped with limit up moves can't even exit their positions. We could be headed for exactly that kind of rapid, explosive process. So within the next 6 months, projections suggest silver could hit anywhere between $300 and $500 per ounce. With some corrections along the way, there will definitely be a stumble in the middle that will scare even ardent silver bulls. But gold would be way north of $5,000 at that point too. Think about it this way. If gold hit $8,000 and did its normal 8-fold move that it's done twice in prior bull markets, that wouldn't be exceptional. That would just be doing what it's done before. And if gold goes to 8,000 and silver goes back to its spread relationship to gold that it had in 2011 when we hit $50. Und von Frosum Yiki Rafi Woven Promfree Unfizu Untrigi Wokbroze, which was 3.1% of gold's price. Well, 3% of 8,000 is $240. But when you also factor in money supply growth, if you take the money supply and calculate what it was in 1980 at the $50 peak and note the money supply growth since then, or do the same calculation from 2011, You come up with numbers well into the several $100 range just to match the real inflation-adjusted buying power of silver at those two previous peaks. Make sure to smash that like button one more time, comment below with your thoughts on these price projections, and subscribe for daily precious metals market analysis. One last critical point before we wrap up, and this is perhaps the most important of all. All of this price action, all of this technical analysis, all of these projections, they're almost a distraction from the bigger issue. The real issue is that the money you have in your bank account, the cash you're holding, the dollars or whatever currency you're using, it's dying every day. Your purchasing power is eroding constantly. Most people are seeing the effects. They see consumer prices rising, but they're not understanding the cause. The cause is money supply expansion. If you look at commodities broadly, technical analysis suggests they're starting their next bull phase, much like the 2020 to 2022 period when commodity prices doubled. Even oil, which has been lagging and which political leaders say they want to keep cheap, shows technical patterns suggesting it's about to break higher. The technical work indicates that just a few dollars above current trading levels, around $60 per barrel, oil could trigger patterns that violently move it up out of the $60 to $70 range. The first thrust could take it to the mid-90s, a 50% increase from recent prices. That would shock the average person when they pump gas and watch the price clicking higher. That's how most people see inflation, at the gas pump, at the grocery store. They don't see the root cause, which is money supply growth. Every decade, the money supply increases roughly 80 to 90%. When central banks print more money to save bond markets, gold goes explosive because it's real money. Half the world already realizes this and is starting to shift away from dollars and toward gold. The Western world has been slow to recognize this reality, but if we get into a severe crisis, they might finally wake up to the fact that this monetary system hasn't been working. The technical view on Bitcoin is actually negative. Projections suggest it could fall to at least $60,000, probably sometime in the first half of this year. That would be a total wipeout for anyone who bought Bitcoin near the recent highs of 107,000. If you get cut more than in half from those levels, any talk of crypto being an alternative money unit will likely fade. Even crypto advocates are starting to look at gold and recognize its enduring role as a monetary metal. That's why these price targets that sound insane, $300, $500 for silver, might actually be conservative when you factor in what's really happening beneath the surface. This isn't just a commodity bull market. This is a monetary crisis unfolding, and gold and silver are the escape valves. If you haven't positioned yourself in precious metals yet, it's not too late, though the earlier you move, the better. And if you already have exposure, understanding these dynamics can help you hold through the volatility that's inevitably coming. There will be scary corrections. There will be moments where it looks like the rally is over. But if the fundamental thesis is correct, and the evidence strongly suggests it is, those corrections are buying opportunities, not exit signals. Thank you so much for watching this deep dive into what could be the most important precious metals story of our lifetime. Drop your thoughts in the comments. I want to hear whether you think these projections are realistic or too aggressive. What's your price target for silver? What's your timeline? Let's discuss. Before you go, make sure you've smashed that like button, left a comment with your thoughts, and subscribe to the channel for daily precious metals analysis and market updates. I'll be back with more coverage as this situation develops. This is history in the making, and we're going to document every step of the way. See you in the next video. Take care.